So on Monday, you have learned about depreciation, right? Depreciation. So depreciation is to recognize the cost of using long-lived eyesights. The reason for that is that on day one, when you have a new eyesight, it has some value, but on the last day, when the eyesight is at the end of the useful life, the eyesight would have a residual value or no value at all, right? So you are saying, well, guess what? On my book, I need to reflect the trend of my eyesight value decreasing, right? So how should I do that? Okay, so every year I will recognize a decrease in value, right? A decrease in value as a way to recognize the value decreasing, right? So for that, I would recognize depreciation expenses, okay, every year. And I'm going to use account to accumulate, okay, this depreciation. That account is called cumulative depreciation. So anytime when you take the difference of the original value minus the cumulative depreciation, so that is your carrying value, okay? We also call it net book value. So that is the value of the long-lived eyesight according to your book. We also call it net book value, or we say this is a carrying amount. So to calculate a depreciation, there are different methods, right? So we have learned about straight line amortization, straight line depreciation. So using this method, the amount of depreciation expenses are the same across all the years of the useful life. Diminishing balance. So under this method, you have higher depreciation expenses in the earlier years. Okay. Units of production. So using this method, we are going to calculate, okay, the amount of depreciation per unit. And then, depending on the number of units for a particular period, I'm going to apply the rate, right? The depreciation amount per unit times the number of units for that period. So that is the three method of the obligation of the depreciation. So we are still within the learning objective number 2. Yeah. Student asking me what objective is this about? This is about the learning objective number 2. Okay. So management will select one of these methods, okay, as their depreciation method. So for straight line method, I have a value at initial value, right? This is when you first purchased the asset, day 0. And then a final value. This is the value when your asset is final day, right? This is final day at the end of the useful life. And the difference is the amount of value to be depreciated. We call it depreciable amount, okay? Depreciable amount is actually the number of the value decreased, right? When you compare initial versus final. In this example, initially the cost of the asset is 33,000 and the residual value is 3,000. Okay. So from 33,000 to 3,000, there is the decrease in value of 30,000, and that is your depreciable amount. So you want to depreciate $30,000 evenly over 5 years. You just use division. So each year you have to realize $6,000 depreciation expenses, and over 5 years, the total amount would be $30,000. Okay, here you want to note the straight line rate. Straight line rate is 100% divided by 5 number of years of useful life. So you are saying every year I depreciate 20%, right? 5 years, that's how much 100% I'm depreciating. Diminishing balance method, you still need to apply a depreciation rate. However, this depreciation rate is not the same as straight line rate. Okay. So this depreciation rate is actually equals to straight line rate times a multiplier. Okay. Suppose we are using a double diminishing balance method. So this double means the multiplier. So double means 2. Okay, so the multiplier will be 2. And we have learned that my straight line rate is 20% per year. So this is 20%. So therefore, my depreciation rate for this double diminishing balance method would be 40%. Okay. So now your starting value, initial value is 33,000, and I'm going to do 40% of that as a depreciation. So 33,000 times 40%, so I get 13,200. Okay, depreciation expense. So in this example, this is a double diminishing method, right? Double diminishing balance method. Units of production method. So first, you want to calculate a unit rate, right? What is the rate? Okay. So what is the depreciable amount? Depreciable amount per unit. Okay, for each unit of output. Per unit output. Okay, what is the depreciable amount? So in this question, the total depreciable amount is $30,000, and the total units of production for the vehicle is, you can run it for 100,000 kilometers. Okay, so you divide your depreciable amount by total number of kilometers. You figured out for each kilometer, I only pay 30 cents, right? So the depreciation rate would be every 1 kilometer, the depreciation cost would be 30 cents. So for 100,000 kilometers, the depreciable amount is $30,000. And then for this year, suppose the number of kilometers driven is 15,000, and each kilometers, the depreciation amount is 30. So 30 cents times 15,000 kilometers. So that's my 4,500 unit production method. So when you're comparing these different depreciation method, here is the straight line and the diminishing and the units of production. So if you take a look at these 5 years, okay, this is the 5 years of useful life. The total depreciation expense is the same, right? Doesn't matter which method you use, right? The fact that from the beginning to the ending, that's 5 years. After 5 years, your value goes from 33,000 to 3,000. So the total depreciation expenses over the 5 years should be the decrease in value, which is 33,000 minus 3,000, 30,000, right? So this is the same. However, the amount of depreciation expenses for each year is different, okay? Now, under the straight line amortization, the depreciation expenses is the same for every year. So each year is 6,000. So for 5 years, so 5 times 6,000, that's 30,000. So that's why straight line amortization means each year you have the same amount of depreciation expenses. For diminishing balance, the depreciation expense is decreasing, okay? So you recognize more depreciation expenses in the early years than the later years, okay? And then this one is the units of production. So the depreciation expenses allocation really depends on the usage of the production units, right? So if you have more units of production for that year, your depreciation expenses will be higher because the calculation is a multiplication, the rate times the actual output, okay? So these are the things we were talking about on Monday. Now, revising depreciation. Revisions may be required. Okay, so in the year of 2024, you think it's 33 to start and to 3,000, 5 years, okay? So that's why you calculate 6,000. But in this calculation, you are taking assumptions. You made assumptions. The first assumption is $3,000, right? This is your estimate, right? You don't know what exactly you can sell it for at the end of the 5 year, right? But you just estimate. And you don't even know if this asset can be used for 5 years. Again, this 5 years is also based on estimation, okay? Well, you probably know this cost, right? Because that's the cost you probably know already. Right? But these two other numbers, you might not know, okay? But every time when you do the calculation, you have to use your best judgment. You have to use your best guess, right? So the thing is that maybe, you know, in 2025, you already recognized $6,000. But then at that time, something happened. Something happened. Okay. At this point, you think you can sell the eyesight for $5,000, which is the salvage value. Okay, and you think it can actually go for, so there are, according to the original estimate, there are only 3 years left, right? 2026, 2027, 2028. But according to a new estimate, you can use it for another 4 years. So you have all this new information and the new estimation. And this new information is going to change the depreciation expenses. Okay, it's going to change the annual depreciation expenses. Okay, so this is what we are talking about. Okay, so suppose sometimes after you realize that actually this useful life should be much longer than what I thought. The 5 years is too conservative. It's actually can be 10 years. The residual value is too optimistic. So actually, maybe the residual value is 0. You can sell it for nothing. Okay? So once you have these changes, you have to recalculate your depreciation, right? Using the new information. Okay, and capital expenditures, additions during useful life. So in this example, they are talking about the vehicles, right? The vehicles. So suppose at the year of 2027, in the beginning, the previous estimate think that there are 5 years useful life. And if you are at the end of 2027, you probably only have 1 year left, right? But what if I replaced my engine, right? At that time, I'm going to replace my engine. It costs me quite a bit of money. So that is a capital expenditure. Because with that new engine, my eyesight can be used for 10 more years. Okay. So my expenditure increased the power to generate income. Therefore, it's a capital expenditure. You need a debit. You need a debit vehicle, right? So now you have a new cost number, right? So now you need to update your depreciation. Okay, and impairment. Sometimes your asset does not worth that much. Okay, so think about the office building in downtown Vancouver, right? Before COVID, downtown Vancouver is very busy, right? Many white collar people are working in those skyrock rise buildings, right? But since COVID, the occupancy rate is low, quite low now. Lots of the office building are not able to be rented. Okay, so if that office building, right, their monthly rent decrease, so their cash flow decrease, right, the revenue decrease. So remember, the value of the asset, right, is really reflected in terms of its ability to generate cash flow, right? The more cash flow you are generating, the asset value should be higher, right? But because of COVID, you have less cash flow, so the office building's value should be lower, right? So if it's lower than the book value, if it's lower than the value recorded on your book, that's called impairment, right? That's called impairment. So you have to revise your depreciation because the value has changed. This revising depreciation, okay, at the intermediate financial accounting level, it will be introduced further and more. But for here, I think we are just happy to know this much. I mentioned about this impairment, right? So here, impairment means your book value or carrying amount of the asset exceeds its fair value. Okay, so the number you recorded on your book is actually more than what is real value. right? So the difference is a loss. The difference is a loss. We call it impairment loss. So the journal entry is when you have a loss. Loss is kind of like expenses, right? When you have a loss, you debit to the loss, right? So you increase the loss balance, you do debit. Just like you debit expenses, you increase the expenses balance, okay? And then you credit the eyesight's cumulative depreciation, okay? So it's just another way to say that previously you did not record depreciation enough, okay? So accounting for natural resources would be something like let's say a mine like a coal mine, right? So those are natural resources. Oil sand, right? In northern Alberta, right? The oil sand. In British Columbia, the forest, right? So these are the natural resources, right? These resources was basically offered by the nature, right? The nature grew the trees, and over the time, there are oil under the ground, right? Due to some kind of biological processes over the years, right? So this eyesight are consumed physically, right? So let's say I'm growing trees, right, in the forest. When I cut off the trees, right, I'm consuming these resources physically. I'm taking the trees away, right? I will, use it as to make furniture, right, stuff like that. So you physically consume these resources, this eyesight over time. Then we have a different terminology in parallel to depreciation. It's called depletion. Okay, depletion. So if it's a natural resources, we don't say depreciation. It's depletion. Okay. And if it's a natural resources, the method often used is the units of production method. Units of production method. This is a method we often use for natural resources eyesight. Reserve value are the fair value of the resources. Okay. So how much on reserve, right? How many trees left? What is the value? Compared to what do you think the value is on your book? If the actual reserve value is less than, what do you think on the book, right? There is impairment. So basically, your book value is over exaggerated. So that has to be decreased, right, by recognizing impairment loss. Some other issues, including significant components. So when you think about the eyesight, right, one eyesight can have different components. So for example, for air flight, okay, so one component for air flight would be the engine, right? Another component for the air flight would be the cabin, right? That's where the passengers are seated, right? But you think about that two components of the same aircraft. So the engine is often most valuable, most important, right? Probably have longer years of useful life. The cabin, the value of the cabin is low, right? Basically, it's just some seats and interior work, maybe compartment above it, above the seat. So relatively speaking, on the cabin, furnitures, the wall, everything, it won't cost as much as the engine, right? And plus, these eyesights, these components will have shorter years of useful life, right? So just because, let's say the chair, right? So people are constantly sitting on it, wearing it out, right? So you probably have to replace a chair more frequently than replacing a engine. So the point here is, even though the two component, the engine and the cabin, they both are part of the same aircraft, but you probably want to depreciate the significant component separately, right? Because the engine is more valuable and the useful life is much longer, right? So therefore, it's unfair to do one calculation for the whole aircraft, right? It may not be accurate. Instead, if there are significant components, you should take that out and do the depreciation separately. Cost versus revaluation model. So under IFRS, so the another model, re-evaluation model is allowed, okay? But for us to study this course, we are studying the cost model, okay? We record the cost of the eyesight, okay? The revaluation model means that they are going to always compare their asset value with the fair value, right? If the fair value changes, they have to change their asset value to reflect market value. And then in that case, they have unrealized gain and loss, okay? But that's probably, I won't talk too much about it because this is really an intermediate financial accounting as concept. For now, just to know that there are two different models, cost model versus revaluation model. And the focus of this course is to do the cost model. Okay, so does anyone have any question?